In today's video, we'll learn about the beginner's guide to investing in the S&P 500 in 2024. The S&P 500 index funds are currently among the most popular investment options today, and it's easy to see why. Even Warren Buffett, a highly regarded investor, consistently advocates for holding these funds. Why? Because of its low costs, diversification across many companies, solid historical performance, and simplicity. Additionally, you own the market by investing in an S&P 500 index fund instead of trying to outperform it. If this appeals to you and you're contemplating adding it to your portfolio, there are crucial details you should understand before proceeding. So, what exactly is the S&P 500? It is a widely monitored index that tracks the stock prices of the 500 largest companies in the United States. Its companies collectively possess assets worth $7.1 trillion. A significant portion of investment flows into index funds, replicating the S&P 500, making it one of the most established and recognized stock indexes globally. Some notable companies listed in the S&P 500 include Microsoft, Apple, Amazon, Nvidia Corp, and Alphabet Inc., Class A, among many others. These companies primarily operate in three main sectors: information technology, 28.9%, financials, 13%, and healthcare, 12.6%. Together, these sectors contribute to nearly half of the S&P 500 index. Investing in any of these companies is surprisingly easy. For new investors, the simplest method is through an ETF or mutual fund. And since the S&P 500 reflects the performance of its underlying stocks, you can't invest in it directly. Instead, you can purchase S&P 500 index funds via a mutual fund or ETF, as both aim to mirror the index's performance. While both options offer a cost-effective means to access the S&P 500 and diversify your investment portfolio instantly, there are differences between the two. Investing with a mutual fund. For instance, when investing in the S&P 500 with a mutual fund, it's essential to understand that these funds typically include most, if not all, of the stocks from the 500 companies comprising the S&P. This is done to closely match the index's performance. There are numerous S&P 500 index-based mutual funds available, and you can use the following criteria to guide your selection. To start, take note of the minimum investment required. Index funds have varying minimum investments, so confirming that the minimum amount fits within your investment budget is essential. Second, as index funds are typically managed passively, the expense ratio, which reflects the ongoing cost of maintaining the investment, is often low. So, prioritize finding a fund with the lowest expense ratio possible. Lastly, if the index fund includes dividends, as many do, compare the dividend yield among the various funds you're considering to ensure you make a well-informed choice. Acquiring an S&P 500 index-based mutual fund is simple. Here's how to do it. Begin by opening an investment account. This can be done through a traditional brokerage or a robo-advisor. Next, decide how much capital you're comfortable investing and deposit the funds into your account. Once you've identified the S&P 500 index fund you wish to invest in, purchase your brokerage account. Most importantly, consider your budget. If you have limited upfront capital, explore brokerage options that suit your financial situation. Luckily, many brokerage firms offer low-fee trading solutions to accommodate different budgets. Investing with an ETF. Like index funds, exchange-traded funds, also known as ETFs, enable investors to combine their funds into a portfolio of stocks, bonds, and other assets. However, unlike index funds, which are traded only once a day at the close of trading, ETFs can be traded throughout the day like stocks, causing their share prices to fluctuate. It's important to note that ETFs come in various types, and not all track-specific indexes are the same. Some ETFs focus on particular sectors, industries, or markets. When investing in the S&P 500 with an ETF, choosing an index-based ETF is advisable. The fundamental considerations for investing in an ETF aren't vastly different from those for index funds. In many instances, ETFs have lower minimum investment requirements than index funds. Sometimes you only need to pay the amount of a single share to get started. Always compare expense ratios among the ETFs you're considering and opt for the one with the lowest ratio possible. Lastly, compare the dividend yields of the ETFs you're considering and aim for the highest yield to maximize your returns. To purchase an ETF, you'll need to start by opening an investment account, which can be done through a traditional brokerage or a robo-advisor. After that, determine the amount of money you're comfortable investing and deposit those funds into your account. Once you've selected the ETF you want to invest in, buy it through your brokerage account. Remember to use the earlier key criteria to compare expense ratios and dividend yields before deciding. Pros. Why do investors like S&P 500 index funds? Investors are drawn to S&P 500 index funds for several compelling reasons. Firstly, they offer consistent long-term returns. The S&P 500 has historically delivered steady annual returns, averaging 11.28% from 1950 to 2023. Secondly, investing in an index fund provides instant diversification across various companies, industries, and sectors, enhancing portfolio stability. Furthermore, opting for an index fund or ETF to access the S&P 500 eliminates the need for intensive stock-picking research, making it accessible to investors without prior investment knowledge or research capabilities. Cons. While investing in the S&P 500 offers numerous advantages, it's essential to be aware of some drawbacks. Firstly, as the index primarily comprises large-cap companies, it lacks exposure to many small-cap or mid-cap stocks, even within S&P index funds. Another consideration is short-term volatility. Although the S&P 500 has historically delivered annual solid returns over the long term, it is susceptible to market fluctuations. Investors must be prepared to endure short-term price fluctuations and prolonged periods of market downturn, such as a bear market. Furthermore, since the S&P 500 comprises only US-based companies, it does not provide exposure to stocks from other regions. While this may be of less concern to new investors, diversifying your portfolio across different geographical areas is generally considered a smart strategy. So, is investing in an S&P 500 index fund a wise decision? It can be, especially for new investors aiming to build wealth for the future, provided they have a time horizon of 3 to 5 years or longer. However, it's essential to remember that any investment can yield poor returns if purchased at overvalued prices. Fortunately, this hasn't been a significant issue for S&P 500 index funds, as investors have typically enjoyed an average annual return of around 10% over long periods. This consistent performance is one of the reasons why Warren Buffett has consistently recommended these funds to investors. When purchasing shares in the fund over time, it's advisable to use dollar cost averaging. By doing this, you're spreading out buy points and avoiding the practice of timing the market. This approach helps you capitalize on any market downturns that may occur occasionally.